we're going to look at ways to make the most of the tax-free cash in your pensions. What's the maximum you can get and how you can access it. So there's two ways of accessing your pension. The first one is called UFPLS, Unfunded Pension Lump Sum, and this involves always taking from your pension in the ratio a quarter tax-free cash and 3/4 taxable income. The other way is flexible access drawdown, where you can take the tax-free cash first and you can take it either all in one go or you can drip feed amounts into your bank account as you see fit. Here's a flexible access drawdown example. The pension pot is 800,000 initially, and we take out 100,000 tax-free cash. That then means £300,000 is now crystallised because it's always in the ratio a quarter to 3/4, and we've got 400,000 remaining uncrystallised in our pension. So it's now 5 years later, we've had growth in the pension of 80%. So the uncrystallised pension has grown to 720,000, the crystallised pension has grown to 540,000, the bank account is zero because we've spent it. Now the most that we can take as tax-free cash is the lower of 25% of what's left in our uncrystallised pension, 180k, or the allowance, which is 268,275, less 100,000, which just gives us the 168,275. So now we take the maximum lump sum allowance remaining, which is the 168,000, then an additional 504,000 is crystallised because again it's always in the ratio 1/4 3/4, and so 48k remains in our uncrystallised pension, and we've got over £1 million in the crystallised pension, lucky us, and the 168k tax-free in our bank account. Now let's look at an UFPLS example. Pension pot again is 800,000. We take 100,000 tax-free cash. There is no crystallised pension account, so all just moves across in one transaction. So 300k also has to be taken as taxable income. So clearly we're not going to use UFPLS to move large amounts of money from our pension into our bank account. So a more realistic UFPLS example would be to take the personal allowance, 12,570, as taxable income, and that's now driving our withdrawal decision, and then we also happen to have 4,190 as tax-free cash, which is a little bonus along the way. Defined benefit pensions can have tax-free cash. Under the old pension rules, 25% of the value of any defined benefit pension was deemed to be tax-free cash, even if you weren't actually entitled to any such money. And now it's only the actual tax-free cash that you receive that will go towards the lump sum allowance. So the lifetime allowance is dead for the time being, and we now have a thing called the lump sum allowance, which is the maximum amount of tax-free cash that you can take from a pension, and it's set at the lower of 25% of the old lifetime allowance, which equates to £268,275, or 25% of your pension. The term lump sum is erroneous because you don't have to take it all at once. So we've looked at tax-free cash in a pension, but there's also tax-free cash within an ISA. So should I take the tax-free cash first from an ISA or from my pension? When you retire, you'll have a taxable savings account or a current account. You probably have an ISA. You might have rental properties, or you should have some sort of other income, even if it's just selling garden gnomes on eBay. You'll have a state pension, possibly a defined benefit pension, a defined contribution pension, and you've got to optimize this for both yourself and your spouse. And it's quite a lot of calculations to be done. The first thing to do is to utilize your personal allowance from these income sources, because if you don't, then you'll just lose it. And you can take tax-free cash from your pension and put it into your ISA, subject to the ISA limits every year, and they're both tax-free wrappers. You can use a retirement calculator to model your tax-free cash. In this example, the couple have a defined benefit pension with some upfront tax-free cash, and then they're using UFPLS to take tax-free cash from their defined contribution pensions, and the tax-free cash here is shown in green. Then here we've modelled marginal income tax rate in retirement and the tax paid each year, and then we've also added up the total income tax paid over the next sort of 30-40 years. So now we've used flexible access drawdown, we've accelerated the tax-free cash in green. So now we're paying a lot less tax in the early years. The only income tax being paid is the result of a combination of defined benefit and state pensions. And total income tax paid over the lifetime of the model has fallen from £319,000 to £307,000. As a general rule, you'll be better off under flexible access drawdown, providing you don't take too much tax-free cash each year. When it comes to a retirement calculator, you've got 4 options: a free website, a paid-for website, using a financial advisor, using a retirement calculator spreadsheet. The pros of a free website are, well, it's free. Cons are, it's a black box, you can't see the calculations, there's very limited functionality, there's no coaching available. A paid website would be difficult to break because you're just putting the numbers into a website. Again, it's a black box. You have to pay money every year, otherwise you'll just lose all your data, and again, no coaching. Financial advisor can be very knowledgeable, comes with coaching, but again, they're just using these black box websites. They're very expensive, and you only get a PDF report when your life is actually quite dynamic. There's quite a lot of change, and so you're going to have to keep going back to the financial advisor to run new models. With a retirement calculator spreadsheet, you've got a low one-off fee. It comes with coaching. So you've got transparent calculations within the spreadsheet. It's fully customizable. The disadvantages are you've got to update it every year, and it's not good if you hate spreadsheets. When taking tax-free cash from a pension, you either want to spend the money within that tax year or move it to your ISA or your spouse's ISA, subject to contribution limits. Don't move money from the tax-free wrapper of a SIP into a general investment account that has dividend tax, interest tax, capital gains tax. But remember that an ISA is subject to inheritance tax, so you don't want an ISA to get too large later on in life. And then if you think like me that the lump sum allowance won't increase in line with inflation, it'll just stay as it is, its purchasing power will decline, so you'll get less bang for your buck on the tax-free cash in your pension if you let it get too large. When considering taking tax-free cash, you have to ask yourself, well, what will happen to the lump sum allowance in the future? Well, I think it's not much of a vote winner if it's increased, but then it's not much of a revenue generator if it's reduced. So I think it will become like the ISA allowance, where it's not really going to be changed at all. It won't be indexed with inflation, and you'll have this fiscal drag where the value of it slowly diminishes over time. If you're not rushing off to sell your garden gnomes on eBay, then maybe check out this next video.